This feels different though from all these little missile attacks and flashes of geopolitical risk that we've seen in the last few years. This time feels different. It's much larger scale. We've got both sides claiming that they're going to retaliate, and we're looking at a different geopolitical risk spectrum in the Middle East.
The difference is that this is the first time that Israel is directly targeting Iran's nuclear sites. And we already have seen Iran retaliating with some drone strikes, but it is very likely that there will be more retaliation by Iran. I think it is very much possible that we see oil prices spike up much further. We think more than $100 a barrel. And in that extreme case scenario, very likely more than $130 a barrel or more.
When you tack on 10% to WTI because of exogenous factors, well, that's really felt at the pump, especially now during the summer drive season.
If we see this, the closure of the Strait of Hormuz, that is the passage for roughly 20% of global LNG trade. Most of it goes to Asia. So we would expect price pressure to come from increased competition for spare cargoes.
If we do see the crisis continue to escalate, how quickly could U.S. shale respond?
I don't know that I would expect the major drillers, the larger cap E&Ps and integrated to react as meaningfully to this as the smaller guys would that tend to act more on the margin. And so I wouldn't expect a significant response.
Good morning, good afternoon, everyone. This is Rob Barnett, and I would like to welcome you to today's BI Energy Exchange. We normally hold these calls on Wednesday, but we decided, given the developments overnight involving Israel and Iran, we would do a sort of rapid fire response discussion here today and give you our breakdown of what's occurred and how to interpret what might be happening in the energy markets. So for the call today, we've got the team from BI. So just quickly running around the world, we've got Salih Yilmaz joining, I believe, from Cyprus here at the moment. Then swinging over to London, we've got Will Hares and Patricio Alvarez. Patricio is normally in Madrid, but sitting there in London, I see today. Then swinging across the pond, we've got Vince Piazza and Scott Levine. Just a quick advertisement too. Gregory Brew from Eurasia Group, he's the Iran expert there, will be joining us for our regular discussion next Wednesday at 10 a.m. New York, 3 p.m. London. So if you want to continue the discussion, join that as well. So just looking at the screen right now, Brent crude is roughly $75 a barrel. And I want to come to you first, Salih, based in the region generally, and give us your quick assessment of sort of what happened and what's your initial takeaway for the oil market.
Sure. Thanks, Rob. And yeah, I mean, Brent is currently around mid-70s, but earlier in the day, it was even higher. Intraday, Brent was at some point up 12%, which was the highest move since 2022 when Russia invaded Ukraine. So what happened in the early hours of today was that Israel striked Iran's nuclear sites, which obviously is a major escalation in between the two countries. And, it may feel like we've been here before. I mean, in the last couple of years, we did have these countries, one of them attacking the other, and then we've been waiting. We waited on the other to retaliate, and it was always a matter of what the retaliation would be like. But the difference is that this is the first time that Israel is directly targeting Iran's nuclear sites. And we already have seen Iran retaliating with some drone strikes, but it is very likely that there will be more retaliation by Iran, and we are just yet to find out what that will be. So I think the point here and the main takeaway for us has been that the geopolitics and the geopolitical risk premium is very much back in the oil market and in oil prices. And this is not our base case scenario, but when this Middle East escalation comes back into play, it is very much possible that oil prices spike much further to potentially higher than $100 a barrel. So what we will be watching next is, as I said, what Iran does next. I think there are two main possibilities. One is what we've seen historically in the last couple of years is it's a relatively contained retaliation by Iran that targets military sites only. And for oil prices and for the oil market, this would be the best case scenario, if you will, where the oil price impact would be very much limited. However, the other option is that Iran retaliates, targeting energy infrastructure directly. That could be energy infrastructure in the region, such as in Saudi Arabia or in the UAE. Or the most extreme case scenario, as we discussed here before, is closure of the Strait of Hormuz, which is a very, very important passage for oil and LNG. It hasn't been done before, but Iran has threatened to do it previously, and this would be the most extreme case scenario for oil prices, because about 20% of global oil supply passes through Strait of Hormuz every day. I think about 25% of LNG passes through this passage every day. So if it were to be closed, which is unlikely, I think, mainly because Iran's own exports go through this strait, but also it would be a way for the US Army to be directly involved. So it is very unlikely, but in that scenario, I think it is very much possible that we see oil prices spike up much further. We think more than $100 a barrel. And in that extreme case scenario, very likely more than $130 a barrel or more.
Okay, thank you, Salih. Will, I want to bring you into the conversation. And just for anyone who's unaware, the team has been really active. Everyone on this call has notes out, sort of diving into various angles of this topic. So in many ways, you can think of BI as a real-time research product where it's very responsive to things happening in the market. So Will, you've got a note out looking at oil-weighted E&Ps in Europe. So I want to get your read there. And I also am curious, since you've been doing this a long time, Salih talked about the upside risk to the market. Give us your read as well. What's the possibility that all this just gets quickly resolved, and then could we be looking at downside again?
Yeah, thanks, Rob. I think I'll take your second question first. And I think it's important to take away from or read through what we've seen so far, and that all indications is that these are the very early stages of what will be days or even weeks of conflict. This is what both sides are saying, particularly the Israelis. And so I think we need to take that seriously and take that at face value, that we are going to see more military action on both sides, because Iran has also promised to retaliate. I think there's another element here that's worth mentioning, is that the target selection from Israel appears to have been very surgical. There's been no civilian casualties, I think, reported, and only military and nuclear sites have been targeted. Now, that's really important, because if Israel had wanted to enact maximum pain, economic pain, you can be sure that they would have attacked, they would have put offline Karg Island, which is Iran's largest export terminal, which sits in the Persian Gulf. So the fact that we haven't seen that, I think, could maybe be seen as there's some reluctance there to go for maximum damage or maximum pain, maybe as a way to keep any retaliation onto military sites. So I know Salih brought up some of the previous crises that we've seen in the region, and we saw Iranian proxies in Yemen, missile and drone attack the Abqaiq facility in 2019 in Saudi Arabia. That knocked out 5.7 million barrels a day. So I think that's the sort of response that I imagine Israel and the West is trying to avoid, and I think that's probably why we didn't see a full scale economic attack vector from Israel. On the European E&Ps, I think that this subsector of upstream energy is probably one of the most exposed to upside oil price movements. Most of these companies are pretty heavily levered. All have very high oil weightings in their production mix, and have also been struggling pretty materially over the last several years. So any upside movement in oil price is pretty significant for these companies. I mean, Tullow has nearly doubled in the last week or so just on the movement of oil prices. They also have hedging programs which mostly protect against downside, and so their upside exposure is usually mostly or entirely intact. So I think this is probably one of the better ways to play the upstream angle from a commodity crisis like this.
Okay, thank you, Will. Vince, let's bring you into the conversation. Like everyone else on the team, you've got a takeout looking kind of at the U.S. oil patch. And I'm curious, just given what we've heard from Will and Salih, if you could also give us your read on just kind of where were the fundamentals before we entered into this highly geopolitical angle on the oil market?
Now, I would say from a WTI perspective, my names are more levered to WTI, but we are so interconnected globally that anything that occurs in any part of the world and in any region or area that could create a major bottleneck that impacts my guys out in the middle of Texas, right? So prior to this, I mean, we're looking at a 60 handle on crude and talking about oversupply. Now we are hinting at the possibility of tighter markets, at least sentiment-wise. But when I look at, just gauges of volatility, so whether it's the, crude oil 60-day historical volatility trend or the CBOE oil ETF volatility index, they are elevated, but not to the extremes, of 2019 and not to the elevated levels of 2022. So it seems a more rational response. And as Salih mentioned, Brent was pricing in a lot higher prior to our call today. I think what my concern is, and I know several of us have mentioned this, is not just an escalation militarily, but also any bottlenecks that can be created or that can occur that would delay the shipment of molecules and the arrival of molecules where they are needed. And I think that is also important. I also mentioned that, here in the U.S., we have an issue of we really don't get a sense, we don't have a sense of the economic backdrop right now. It's pretty much touch and go. Inflation doesn't really seem to be that elevated, but when you tack on 10% to WTI because of exogenous factors, well, that's really felt at the pump, especially now during the summer drive season, the all-important summer drive season. But my guys are responding the way you would think my guys would respond. The oil complex is up. Natural gas, not up as much, obviously, and primary reason for that is with more production of oil comes more production of associated gas. Associated gas, it is a extremely large component of the overall natural gas mix. So more oil or higher oil price enticing operators to turn the spigot on would not be good for associated gas production and natural gas balances in general.
Okay, Vince, thank you. That's a good segue. Patricio, let's come over to you and get your read on the gas market. I know you've got a note out talking today about the prospect of TTF being over 50 euros a megawatt hour. Prior to the geopolitical forces entering the market here, I think you had a much more tepid view. So give us a sense, how much does this flip the narrative in your perspective?
Hi, Rob. Thanks for having me. So yeah, the narrative that we had, or like yeah, the fundamental view for European gas prices prior to this geopolitical event was it was broadly bearish. We expected European gas prices to stay range bound, 30 to 35 euros per megawatt hour. That's mainly because of the demand story in China, which I think has surprised to the downside. LNG imports in China have been falling for 7 months consecutively for 7 months, so that has allowed for faster restocking of European storages. But that said, European storage is still tracking nearly 20% below where it was last year at this time. So there's still a pretty big gap. So still fairly uncertain re-injection season here in Europe. In terms of the potential impact from this potential escalation in the Middle East, I think it's important to separate what we view as sort of the tail risk event, which is the closure of the Strait of Hormuz, and what has been already impacting trade flows in the Middle East. So just for context, Europe only imports roughly 15 billion cubic meters of gas from Qatar. And in the Middle East, Qatar is the largest exporter of LNG to Europe. That said, that is roughly 4 to 5% of European gas demand. So we think that could be absorbed by other suppliers. And we should also mention that trade flows, or LNG trade, has shifted already due to Houthi rebel attacks. So since the fourth quarter of 2023, LNG flows via the Red Sea have been suppressed significantly. So we don't see very material direct impact. But on the other hand, if we see this, the closure of the Strait of Hormuz, that is the passage for roughly 20% of global LNG trade. Most of it goes to Asia. So we would expect price pressure to come from increased competition for spare cargoes. European gas markets, roughly 2/3 are secured under long-term contracts. So that means that Europe must go to compete in the spot market for the remaining 35 to 40%. So we would expect more price competition seen in JKM, so Japan Korea marker, to Henry Hub spreads. And on the other side, a lot of the contracted volumes are oil price indexed. So it was similar to what Salih was saying at the beginning. In a scenario where oil prices go north of 100, that would be sort of our most bullish scenario for gas, would be that European gas follows it at around 50.
Okay, thank you, Patricio. Scott, let's come over to you to just close the loop from everyone here on the call. Given that you cover the energy service names, some of the drillers, give us your sense. How long would prices need to be elevated before you'd start to see a material change in the outlook for rigs and whatnot?
Yeah, I mean, it's an interesting question because, what would a material change that would imply an increase, right? We're in the process of a material decrease in the rig count right now. Since the beginning of the month, Patterson-UTI has announced that they project a 5% decrease in the rig count in North America in June. Over the last month, we've seen a 5% decrease in the rig count. So the change in my mind would be more a stabilization rather than an increase in drilling activity based on the current backdrop. Look, we're at 559 rigs in North America. That's down about 5% over the last month, as I mentioned. Our year-end rig count projection is at 550. And that I would say discounts $60 to $65 oil. So to answer your question, I think we would probably need evidence that this is going to be a prolonged, and by prolonged, I think a month of escalating tensions, not to dive into what Salih said at the outset in terms of what would constitute that. But I think on the margin, what this does is give us increased confidence that that the downside would be more limited from here than anything else, rather than talking about folks adding rigs back in the U.S. Or anything along those lines. I do think that the deterioration in the fundamental backdrop is probably worse for North America shale producers than it is for international producers, and the rig count developments we've seen over the last few weeks support that view. But I think, like, if anything, this development gives us greater confidence that we maybe don't go below 550, and that the rig count stabilizes during a period where we've seen enormous deterioration. If we get to a situation where $100 oil and that tail risk becomes more of a likely case, then it's a different story. But I think it's going to take some time, obviously, to get from here to there, even with the abrupt sell-off that we've seen. So if anything, I think that recent developments here give us greater confidence that we see a stabilization in activity while we await further clarity on the geopolitical situation.
All right. Thank you, Scott. For everyone listening, we see that you've been asking questions. There's some in the webinar chat. There's some via the Q&A function. So we will try to get to them. So if you have questions, drop them in. We'll do our best. Salih, I want to swing back over to you and just get your read on potentially how's OPEC plus or OPEC going to generally approach the market given these developments?
Sure, I think it's a good question, and it's one that we will be watching very closely in the next couple of months, because perhaps one thing that could give a little bit of comfort to the market in a situation like this, where we could lose some Iranian barrels, would be spare capacity within OPEC and OPEC plus. And currently, OPEC plus, the estimate has spare capacity of more than 6 million barrels per day. So you can argue that this type of spare capacity could act as a cushion against any sort of disruption. But I think it's important to remember that spare capacity is very much concentrated within Saudi Arabia and the UAE, and it's only useful and relevant if that spare capacity can be utilized. And as I was saying earlier, in a scenario where perhaps Strait of Hormuz can't be used as it normally is, then that spare capacity may not be as useful. In terms of what this means for the group, I mean, obviously, as long as they can still produce what they were producing just before, and they are exporting what they can, they are set to benefit from this given the higher pricing environment. But then there will be pressure on the group, I mean, probably most importantly from President Donald Trump, for them to produce more because it is known that they can. But I think it's important to remember what happened back in 2018, where in wake of sanctions on Iran, perhaps prematurely, Saudi Arabia and OPEC started increasing production, only then to have some exemptions on Iranian sanctions to follow, which actually didn't really work in their favor. So remembering that precedence, I think the group led by Saudi Arabia would probably be pretty cautious in bringing barrels back. But when we look at what they were planning, they are planning to bring back 411,000 barrels per day in the next couple of months. I suspect they will do similar hikes for August and September. But again, I mean, things are obviously very fluid, and we don't really know what type of disruption will actually materialize. So that's on your question on OPEC. Perhaps very briefly, if I may, there was a question on an attack on the Tabriz refinery. I haven't seen this. I mean, earlier in the day, I did see some tweets on there may have been an attack on another refinery in Iran, but then I don't think it was correct. I think it was a video from 2020. So I don't know if this is true. But my 2 cents on it would be that it wouldn't really matter so much for global balances. This is not a refinery that exports any of the products, as far as I'm aware. And perhaps reiterating the point that Will was making earlier, I think the biggest impact would come from the Karg island, which is the majority of exports for Iran. So anything on Karg Island, anything around Strait of Hormuz, and anything on the production facilities in the rest of the Gulf would be a lot more impactful. So on its own, it wouldn't have so much impact, but if you view it as part of a wider kind of attack program by Israel, sure, like it could add a little bit more geopolitical risk premium, but it wouldn't directly impact global balances for crude or for products. So just my 2 cents on that question from the Q&A.
Thank you, Salih. I'm just looking at the screen right now, and the MSCI World Energy Index is up about 4% year to date. The XLE, which is more U.S. focused, is up about 1% or so year to date, so which is lagging the sort of broader world market indices. And so, Will, I'm curious to come back to you, and because you were talking about some of the read into the European E&P names, is this kind of geopolitical event something that could perhaps bring some excitement and enthusiasm back to the space? I think I was just talking year to date, but generally the space has been a little beaten up over the last couple of years. So kind of how do you read into kind of how the names have been performing?
Yeah, well, I think it's a good question, because you can look at the reasons why our sector has been sort of on the back burner for a lot of investors, and it's really multifaceted. But the leading reason why is because of excess supply. There's just been this massive non-OPEC supply growth. We've had large excess capacity from OPEC. We've had tilting demand signals, especially from China. And on top of that, we've just got like the geopolitical risk spectrum has also been relatively calm, even though we've seen these little flashes of conflict in the Middle East. Nothing has really risked supply whatsoever. And so, but this feels different though, from all these little missile attacks and flashes of geopolitical risk that we've seen in the last few years. This time feels different. It's much larger scale. We've got both sides claiming that they're going to retaliate, and we're looking at a different geopolitical risk spectrum in the Middle East. And I just wanted to follow up on some of the questions as well in the chat here. We've got a listener that was asking about the Strait of Hormuz. And yeah, I just wanted to reiterate that the Strait of Hormuz is a maritime passage in between Oman and Iran. And a part of that is between Iran and the UAE as well. So yes, Iran can do a lot, and they have in the past. They have threatened repeatedly to close the Strait of Hormuz. Whether they would go through with that would be a major escalation, as Sal was detailing. But in the last several years, they've seized merchant vessels through it. So they have shown an ability and a willingness to disrupt global commercial traffic, marine traffic through the Strait of Hormuz. Now, would they block it? It would be such a major escalation, because they'd be cutting off their own ability to export oil largely to China as well. So it would be incredibly self-defeating, as well as hurting the rest of the energy infrastructure and global economy. So that would be a sort of break glass option for Iran. I also wanted to answer the question about China from a client. So China is the largest buyer of Iranian exported crude. They buy almost all of Iranian crude that is exported through the Strait. So you can be sure that they are exerting as much political pressure right now to de-escalate things between Israel and Iran. They do not want any economic or energy supply disruption to come as a result of this. So you can believe that China will be on the side of on the side of de-escalation. So I think everyone outside of Israel and Iran probably wants de-escalation to occur as soon as possible here.
Thank you, Will. Vince, I want to swing back around to you and synthesize a few of the questions here. But, you and I have waxed philosophically a number of times about the fact that the energy component of the S&P 500 has been sort of declining over time. Partly that's because of the sort of tremendous rise of the tech industry as opposed to sort of the collapse of the energy sector per se. But let's get your read into just kind of how to maybe think about positioning within the U.S. E&P space, given this this geopolitical concern that we're all talking about now.
Yeah, sure. So, this is an exogenous factor that's playing a role here, and it's not an organic demand supply issue. So if you were an investor and 3.5% of the index is energy, and the three largest global names make up the biggest component of that index, Exxon, Chevron being the biggest two, and those names I cover, along with ConocoPhillips. Those would be the names that tend to be the most liquid, the largest, most globally exposed to market forces. So what has tended to happen historically on events such as these is that it's an offensive and a defensive position where you have these three large components in the index that offer quote unquote leverage to the idea of higher prices, but are not overly exposed from a balance sheet perspective, and also have a fairly stout balance sheet to protect you on the downside. A dividend stream, share buyback to support the stock as well. So in the past, what has occurred is folks tend to recast or refocus their attention on those larger cap names that tend not to be as highly beta sensitive, but do provide that alpha that in the past provided investors some coverage or some exposure during these exogenous events.
Okay, thank you, Vince. And since we are running over, I will just quickly flag that, I did mention at the start here that pretty much everyone on the team has a note or a couple notes out on the terminal. We'll follow up and send an email around with the replay for this, plus all of the research that the team has been putting out. Scott, I want to come over to you with a sort of bigger picture question as well. If we do see the crisis continue to escalate, how quickly could U.S. shale respond, in your opinion? What you're talking about declining outlook for rigs. What if the U.S. needed to produce more quickly because this looks like it's going to be more disruptive and not a short duration thing?
The way I would probably think about that question is that, I would expect the smaller, more independent operators that tend to act more aggressively on the margin to be more aggressive in capitalizing on what would be a geopolitics-driven spike in oil prices. I don't know that I would expect the major drillers, the larger cap E&Ps, and integrated to react as meaningfully to this as the smaller guys would that tend to act more on the margin. And so I wouldn't expect a significant response. I do think it would be rapid. Those guys tend to be more of your shorter cycle operators that tend to play the spot market more aggressively, but aren't as significant producers. So I think you could expect it to be quick, but I wouldn't expect it to be large in terms of the impact from shale on the changes in the oil price. Like I say, the larger guys that tend to more meaningfully contract with the larger land drillers tend to be, I don't want to say more thoughtful. That doesn't really, know what I'm trying to say here, but it's the smaller independent guys that tend to act more on the margin. And they're also the ones that tend to lay down rigs on the margin when things go the other way. And so, again, that's the reason I think we need to see some sustainability here and an indication, not even so much that oil prices are going to go up to $100 a barrel per se, but maybe more that they're going to stay, at $75 a barrel for longer. And that the fundamental backdrop shifts in order to drive change in behavior on the part of the larger guys. So maybe you could see, and maybe the one other thing I would say is we have seen a shift in, and this is something Salih could speak to as well. OPEC, in terms of ramping up production over the last few months, suggests to some extent that they are going for more market share, right? And so if indeed that is the case, and if indeed shale producers believe that, then, their more intermediate term expectations and drilling plans are being affected by this. And I think that has been what has driven a decrease in drilling activity expectations for 2025 and for the back half of this year. So I don't think that this geopolitical shock necessarily changes that. Or at the very least, I think we need a period of time in order to digest everything that's going on in order for folks to fundamentally alter their drilling plans for the second half of this year. So I think you can expect a small change in the margin. I think it's a smaller independents that drive that. I don't expect it to be meaningful, at least over the next week or two.
Okay, thank you. Patricio, let's swing back over to you for some final commentary on the gas side of the equation. I feel like Europe has gone from one crisis to another. I feel like they just got through, perhaps, or they've sort of alleviated some of the shock that happened with the Russia-Ukraine war, and maybe now they're looking at another shock. So does what we're seeing here just accelerate the hope and aspiration and drive that some of the European policymakers have to wean the region off of gas? And are those aims and aspirations even feasible?
Those are difficult questions to answer today, but I think the way to see it is that the EU will still push to wean itself off Russian gas fully by 2027. I think we're still on track to do that. Russian gas supplies only account for roughly 7% of supply right now in Europe. But the story is that that's, like you said, we're shifting from one crisis to the next. The reality is that global LNG markets now have effectively replaced the share of Russia's piped supply into Europe. So roughly 40% of our supply comes from global LNG sources, nearly 50% of that from the US. So to try and answer your question is, I think the policymakers will continue with their drive to try to carve out fossil fuel demand with as much renewables as possible. But we don't think that gas demand is going to decline significantly over the next decade. And that's mainly because it has already declined roughly 17% since 2021. And there are certain sectors of industry, especially, and the rollout of EVs, of electric vehicles, that seems to go slower than what policymakers would like to have. So to your question, I think that directionally policy will continue in the same direction, but I think European gas demand does not have that much more downside scope than where it is now.
Okay, we'll have to leave it there. We've run over, and I want to be respectful of everyone's time. But as you've heard today, it sounds like there's some real risk and probability that this is not super short-lived, that this will continue to influence the narrative and conversation around the oil market. So again, next Wednesday at 10 a.m. New York, 3 p.m. London, we are planning to have our regular weekly call, and we will be joined by Greg Brew from Eurasia Group for that one, or at least tentatively he's agreed to join us there. So look to join us on that, and we will follow up with an email with links to all the sort of research and notes and data if you want to jump in to go deeper on this topic. Also, we're all green dots on the terminal right now, so if you have follow-up, if we didn't get to one of your questions or you just have additional things you want to ask us about, just shoot us an IB, and we will try to get back to you as soon as possible. So thank you, everyone. I hope you have a great rest of your Friday and a lovely weekend. Take care.